Have you ever wondered where banks actually get the money they lend you? Most people think banks lend out money from depositors. Like there's some vault in the back where your neighbor's savings are sitting, waiting to be loaned out to you for your car or house. But here's what nobody tells you. That's not how it works. At all. When you walk into a bank and take out a loan, something almost magical happens. The bank doesn't reach into a vault. They don't transfer money from someone else's account. They literally create new money. Out of thin air. With a few keystrokes on a computer. I know that sounds insane. It sounds like a conspiracy theory. But it's not. It's how our entire monetary system actually works. And once you understand this, you'll never look at debt, savings, or the economy the same way again. Here's what's really happening behind the scenes. Every time someone takes out a loan, the total amount of money in the economy increases. Every time someone pays off a loan, money disappears. Think about that for a second. Money isn't this fixed thing that just circulates around. It's constantly being created and destroyed. Billions of dollars appear every single day. Billions disappear. And the crazy part? Most people have no idea this is happening. They still think money works like it did 100 years ago. Gold in a vault, fixed supply, one person's loan coming from another person's deposit. But that world is gone. We live in a completely different system now. A system where private banks have the power to create money. Where the money supply expands and contracts based on how much people are borrowing. And here's why this matters to you personally. Understanding this changes everything about how you should think about debt, about inflation, about why housing prices keep rising, about why your savings lose value over time. The people who understand this system, they make different decisions. They position themselves differently. They see opportunities that everyone else misses. So let's pull back the curtain. Let me show you exactly how this works. When you apply for a loan, the bank looks at your credit score, your income, your assets. They decide you're trustworthy enough to pay them back. And if you are, they approve your loan. Now, here's where it gets wild. The moment they approve that loan, they don't go find that money somewhere. They just update two numbers in their computer system. Let's say you're borrowing $10,000. The bank types $10,000 into your account. That's your deposit. You can spend it. It's real money. But at the exact same time, they create another entry. You now owe the bank $10,000 plus interest. That's your loan, your debt. Two entries, two numbers. And boom, $10,000 just appeared in the economy that didn't exist 30 seconds ago. You're probably thinking, wait, that can't be legal. That sounds like counterfeiting. But it's not only legal, it's the foundation of our entire monetary system. This is called fractional reserve banking, or more accurately, it's called credit creation. And banks have been doing this for hundreds of years. Now, there are some rules. Banks can't just create infinite money. They have reserve requirements. They need to hold a certain percentage of their deposits as reserves. They need to have enough capital to absorb losses. But here's the thing. Those reserve requirements are surprisingly small. In the United States, for many types of accounts, the reserve requirement is literally 0% now. Zero. That means for every dollar the bank has in actual reserves, they can create many, many more dollars in loans. The money multiplier is huge. So where does the original money come from? The reserves that banks hold? That comes from the central bank, the Federal Reserve in the United States. The Fed creates what's called base money. They can literally create dollars whenever they want. They do this by buying government bonds. They pay for those bonds by crediting banks' accounts at the Fed. New money appears. Then banks take that base money and multiply it. They lend it out. Those loans become deposits. Those deposits get lent out again. Each cycle creates more money. This is why economists talk about different types of money. There's M0, the physical cash. There's M1, which includes checking accounts. There's M2, which includes savings accounts. Each level represents more and more money that exists only as numbers in computers. And here's what makes this really interesting. The vast majority of money in our economy isn't created by the government. It's created by private banks making loans. When the economy is growing, people borrow more. Banks create more money. The money supply expands. Everyone feels wealthier because there are literally more dollars floating around. When the economy contracts, people pay off loans faster than they take new ones. Money disappears. The money supply shrinks. Everyone feels poorer because there are literally fewer dollars in existence. This is what happened in 2008. Banks stopped lending. People couldn't get loans. The money supply contracted, and the economy collapsed. The Federal Reserve panicked. They did everything they could to get banks lending again. They dropped interest rates to zero. They created trillions in new base money through quantitative easing. Why? Because in our system, we need banks creating money through loans. Without that constant creation of new money, the economy seizes up. Now let's talk about what this means for you, because this isn't just abstract economic theory. This affects your life in very real ways. First, it explains inflation. When banks are creating money faster than the economy is producing goods and services, you get inflation. Too many dollars chasing too few things. Your savings account loses purchasing power not because you're doing something wrong, but because new money is constantly being created through loans. Your slice of the pie stays the same size, but the pie keeps getting bigger. This is why keeping large amounts of cash feels like watching your wealth slowly evaporate. Because in a very real sense, it is. Second, it explains why the system favors borrowers over savers. People who take on debt early in life, who buy assets with borrowed money, they benefit when inflation kicks in. They're paying back their loans with dollars that are worth less than the dollars they borrowed. The real value of their debt shrinks over time. Meanwhile, the assets they bought with that borrowed money often increase in price as the money supply grows. This is the hidden transfer of wealth, from people who save in cash to people who borrow to buy assets. Third, it explains why housing prices keep rising. When banks create more money through mortgage lending, that new money flows into the housing market. More dollars competing for the same houses, prices rise. The people who bought houses 20 years ago didn't just get lucky. They position themselves correctly within this system. They use the money creation process to their advantage. Fourth, it reveals why financial crises happen. When everyone's borrowing and banks are creating money like crazy, asset prices inflate. People feel rich. They borrow even more. But eventually, something breaks. People can't pay their debts. Banks stop lending. Money stops being created. The money supply contracts. Asset prices crash. It's not because people suddenly became less productive or less valuable. It's because the money that was propping up those asset prices literally disappears when loans get paid off without new loans replacing them. Let me tell you about two people, Jake and Maria. Same age, same income. Both graduated college in the same year. Jake believes in being responsible with money. He saves diligently. He avoids debt like the plague. He keeps his money in savings accounts and certificates of deposit. He thinks borrowing is risky and wants to pay cash for everything. 10 years later, Jake has saved $80,000. He's proud of this. He feels secure. He thinks he's doing everything right. But here's what Jake doesn't realize. In those 10 years, the money supply increased by about 50%. His $80,000 in purchasing power is worth maybe $60,000 in real terms compared to when he started. Meanwhile, all the houses he was saving to buy with cash went up in price. The $150,000 starter home he wanted is now worth $250,000. He's actually further from his goal than when he started. Now let's look at Maria. Maria understands this system. She takes out loans strategically, not for consumption, not for things that lose value, but for assets. She buys a small condo with a mortgage, 3% down payment. She's using the bank's money creation power. The bank literally creates the money for her mortgage, and she gets to control an asset worth much more than her down payment. Over the same 10 years, Maria pays her mortgage every month, but the value of her condo increases with inflation and rising housing prices. She's paying back her loan with dollars that are worth less than when she borrowed them. Plus, she's building equity. Part of every payment reduces her loan balance. Meanwhile, the asset value is growing. 10 years later, Maria's condo is worth significantly more. She's built substantial equity. She refinances, pulls out some equity, and buys a second property. She's using the system's money creation power twice now. Jake and Maria started at the same place. They both worked hard, but Maria understood something Jake didn't. In a monetary system where money is constantly being created through debt, the strategy isn't to avoid debt entirely. It's to use debt strategically to acquire assets that will appreciate as the money supply grows. Jake was playing by old rules. Rules from when money was backed by gold and had a fixed supply. Rules where saving cash made sense because money held its value. Maria was playing by new rules. Rules where money is created by banks through loans. rules where inflation is built into the system, rules where assets beat cash over time. The difference wasn't about risk tolerance or being smart with money. The difference was understanding how the monetary system actually works. Now, I'm not saying you should go out and borrow money for everything. That's not the lesson here. Debt used for consumption, for things that lose value, that's still a trap. Credit card debt at 20% interest is still a disaster. But debt used to acquire productive assets, in a system where the money supply is constantly growing, that's different. That's working with the system instead of against it. Here's the uncomfortable truth nobody wants to talk about. The monetary system is designed this way on purpose. It's designed to encourage borrowing and spending. It's designed to punish saving cash. Why? Because our entire economy depends on constant growth. Growth requires investment. Investment requires borrowing. Borrowing creates new money. New money drives spending. Spending drives growth. It's a cycle. And the system needs that cycle to keep spinning. When people stop borrowing, when they try to save in cash, when they pay down debt faster than they take on new debt, the money supply contracts. Growth slows. The economy struggles. So the system is designed to make saving feel bad and borrowing feel good. Low interest rates, easy credit, inflation that erodes cash value. It's all pushing you in one direction. Now, you might be thinking this sounds kind of manipulative, kind of unfair to people who don't understand it. And you'd be right, it is. But understanding it means you can make better decisions. You can stop fighting against the current and start swimming with it. This is why financial education matters. Not the generic advice to make a budget and save 10%, but real understanding of how the monetary system works, how money is created, how inflation happens, how debt and assets interact in this system. The people at the top, the wealthy, they all understand this. They use debt strategically. They hold assets, not cash. They borrow at low rates to buy things that appreciate. They're not smarter than you. They're not harder working. They just understand the game being played. And once you see it, you can't unsee it. Every financial decision looks different. Every news story about the Fed or interest rates or inflation makes more sense. You start asking different questions. Not should I avoid debt, but what kind of debt? Not should I save money, but in what form? You realize that in a world where money is constantly being created out of nothing, where the money supply grows every year, where inflation is the default setting, the old rules don't apply. The question isn't whether banks should be able to create money. That ship has sailed. That's the system we have. The question is, now that you know how it works, what are you going to do differently? Are you going to keep saving in cash while the money supply inflates? Or are you going to acquire assets that grow with the money supply? Are you going to avoid all debt out of fear? Or are you going to use debt strategically to build wealth? Are you going to let this system work against you? Or are you going to make it work for you? The money creation process isn't stopping. Banks will keep making loans. The money supply will keep growing. Inflation will keep eroding cash value. This isn't changing, but your understanding just changed. And that changes everything.